we are seeing moves there, particularly in silver, like we never have seen before. I did in my October letter, I raised my silver target from 75 to 100. In my most recent letter that came out last week, first quarter letter, I raised it again to 125. So I'm looking for, still a lot more upside here. And as I said in my letter, because we're in a parabolic, that 125 could just easily be 135 or 45. And maybe a couple guys out there talking 200 and 300. Now, I don't know if they really think you can get there in my time horizon, because I have a $500 target on silver. It's just not now. It's early 2030s. Silver, I think, probably has the more upside here. I raised my target on gold to 5,500 from 40. I guess it was 5,000. Yeah, I raised it in October to 5,000 and just raised it again to 5,500.
We are witnessing unprecedented price action in the silver market, a move so powerful that it is forcing rapid upward revisions of short-term price targets. As the metal enters a parabolic phase, analysts are warning that traditional resistance levels may no longer apply, with momentum potentially carrying prices well beyond initial expectations. David Hunter, Chief Macro Strategist at Contrarian Macro Advisors, noting that he has aggressively raised his silver target from $75 to $100 and most recently to $125 in his first quarter letter. He argues that in this volatile environment, an overshoot to $135 or even $145 is entirely possible, though he maintains a long-term cycle peak of $500 for the early 20s. Hunter also highlights significant upside for gold, adjusting his target from $5,000 to $5,500, confirming that the precious metals bull run has substantial room to run. Now, we present the clips from David Hunter's interview. Before we continue to discuss this, please subscribe to our channel and activate the bell icon for timely updates. Thank you, and enjoy the video.
The bull market will be driven by lower rates. I keep saying the bond market, I think, is poised for a big move in 2026. I am also obviously can't ignore what's going on in the metals. I mean, we are seeing moves there, particularly in silver, like we never have seen before. I did in my October letter, I raised my silver target from 75 to 100. In my most recent letter that came out last week, first quarter letter, I raised it again to 125. So I'm looking for still a lot more upside here. And as I said in my letter, because we're in a parabolic, that 125 could just easily be 135 or 45. It's when you get into that vertical, there's no magic to what point it stops. It's going to burn out quickly at some point. But I think there's still plenty of upside ahead. The institutions still aren't on board with the silver or gold, really. Gold more than silver, but silver, I think, probably has the more upside here. I raised my target on gold to 5,500 from 40. I guess it was 5,000. Yeah, I raised it in October to 5,000 and just raised it again to 5,500. Just look at silver in the last few months, and you'll have your description of parabolic. I mean, and that's what I'm saying. Silver went from, I don't know exactly when this was, but from 30 to, now 90, triple in a year's time, or less. So it may sound crazy to say we're going to cover 40 or 50% of the market in 3 to 6 months' time, but that's what a parabolic takes you, can give you. And so that was always why I said, well, it could come as soon as 6 months from now. I never said 6 months from now. I said it could come as soon as, but what gets interpreted is they hear the 6 months. So they say, well, you said it was going to top out in 6 months. No, I said if all things fell into place, it could be as soon as that. And that's the reason I would use that, is because of that parabolic final part of it, and that I thought we were getting closer to that. Well, certainly the central banks are buying it. Certainly China's buying it. Certainly the BRICS are buying it. I think other countries are. I think maybe some of the Eastern Europe have begun accumulating gold. And certainly institutions have to be starting to accumulate gold. I mean, the gold story has been around for a couple of years now. Silver's later, but certainly gold, I think, has been a few years here. And so the institutions have had time to kind of move away from the idea that, well, gold, the Warren Buffett idea that gold doesn't pay you anything. There's no dividend, there's no earnings or anything. So, he was never a fan of gold, but gold is a monetary asset. And certainly there's a lot of reasons why it's moving up. But right now, demand far outstrips supply, and prices are going to continue to go up. Certainly for the central banks, and certainly for the BRICS, they think if they can accumulate gold and move to some sort of a gold-backed currency, that they can compete with the dollar. And I think that's their long-term plan. And it's that plus the fact that I think for all central banks in all countries, everybody kind of could step back and say, the world we live in today is uncertain. The fiat currency environment is uncertain. We want some gold as a hedge or a protection against what it looks like, which is to get out of this massive debt of 330 trillion around the world. There's only one way you're going to get out of that, and that's to print more money, right? And you're not going to get out of it, but the only hope you have is to print more money. So it seems naturally that you would want something that moves up with inflation, moves up with liquidity, and I think that's a lot of what's behind gold, kind of from afar. Near term, it's more the central banks are buying it, and there's not enough gold around. Silver, should be front and center for everybody because it's moved so quickly from 50 to 90, and you've got people, I had 75 as a target for several years, and I was way above almost anybody. There were people that thought we might double top at 48, but then there were lots of people that thought it couldn't get above 35. And when it blew through 48 and 50, it was at 75 very quickly, and then kept going. It's paused for a little while, and next thing you know, you're at 80 and 90. There's one guy anyway, and maybe a couple guys out there talking 200 and 300. Now, I don't know if they really think you can get there in my time horizon, because I have a $500 target on silver. It's just not now. It's early 2030s. But I think this guy, and one in particular, is talking about more this year. And like I said, if you go into a parabolic, I can't argue that can't happen, that we can go to 200. I would have a hard time thinking that's what we'll do, but it's not impossible. And that's a big statement to say that an industrial metal, an important metal, a metal that's certainly watched by a lot of people, could go from being $30 less than a year ago to something 7 times that number. That seems pretty incredible. So I'm gonna be watching that like anybody else. I have 125 as a number, and that's pretty exciting. But I don't know what the next few months brings. It could just blow through that. And you keep hearing that there's a shortage of physical, that the paper dwarfs, and that there's a lot of shorts on the paper, particularly in the European banks. So who knows what happens there? I mean, so I'm watching that almost more out of fascination to see what really does come of that. I'm comfortable with my forecast, but I also know it could blow right through that.
Sure.
And then I just think the equity market this is history. I mean, I really do believe we're at the end of a 43-year secular bull market. Whether it tops in April or tops in June, or again I have to extend. I don't think so, but it could. Any way you slice it, I think we're very close to a top relative to the fact that it started in 1982. And again, there's another thing. The Dow, Dow is what, 49,000, and that started this move back in 1982. Because I followed the Dow more than the S&P back then, so it's etched in my mind. I think it was 780 at the bottom in 1982. So it's gone from 780 to 50,000. I mean, this is one hell of a bull market. Again,
Yeah.
it's a secular bull market. There have been cyclical bears within that, but So just the fact that this thing could go parabolic, that the equity market could go parabolic, I think that's going to be really interesting to watch in the next, 3 to 6 months too.
A convergence of monetary forces is driving a potential melt-up across asset classes, with 2026 poised to be a pivotal year for the bond market. While institutional capital has been slow to embrace precious metals, central banks, particularly in China and the BRICS nations, are aggressively accumulating gold as a hedge against a $330 trillion global debt burden. This monetary shift is fueling a parabolic rise in silver, where physical shortages and massive paper short positions in European banks could force prices well beyond the revised $125 target, potentially triggering an overshoot to $200 or $300. Simultaneously, the equity market appears to be nearing the explosive finale of a 43-year secular bull run, suggesting a volatile climax where industrial demand and monetary debasement collide to redefine valuations. Let's get back to the interview.
When we look at the Fed balance sheet in 2008, it was 875 billion. That was the largest it had ever been from 1913. Fast forward through the 2008-9 downturn and the response to that and QE1 and 2 and 3, and you're up to 3.7, I think 3.7 trillion. And then the pandemic hit, and we went from 3.7 to 9 trillion. So we have never seen, and that happened over the course of 12 to 18 months, where they panicked, they closed the entire world economy down for a quarter, and they said we got to do something to offset that. So they panicked and printed money like crazy. So you had 5 trillion go into the market or into the system, and that's just Fed money. Well, obviously other central banks did similar. So we've never had 5 trillion. We never had 5 trillion as a balance sheet. Never mind 5 trillion put into the system in a year and a half. And so you never know. I mean, it's unprecedented. It's nothing we can go back and look at past history. You never know how much of that money, how long it's going to take for that money to kind of flow through the system and be used up. We're still going. I mean, that 5 trillion is still part of why we're still going. So from that side, I would argue we're just in uncharted territory in terms of Fed liquidity and liquidity in general that's kept this thing afloat. From a technical perspective, what we've had, which is amazing to see, is that, and I'll really start from 22, from the bottom in October 22. Keep in mind, people were expecting at that time the market bottomed at 3,500 or thereabouts, and the majority of calls at that time were saying we're almost decidedly heading for 3,200, maybe below 3,000, and they were bearish. We moved up. When they saw the thing come out of the 3,500 and move up, most of the street was, yeah, okay, you can get a bounce. It was oversold. It can go a few hundred points, but it's going to roll over. And all the way up from 3,400, 3,500 to 3,800, 4,000, 4,200. That's all you heard was it's a bear market rally. Yeah, it's extended more than I expect, but it's rolling over. And so they stayed skeptical. When it got above, and I can't remember exactly, but I think above 4,300, certainly above 4,500, people started getting more on the bandwagon, saying, well, this has a little more legs. But 4,800 is the high that we came off of back at the end of 21. So we're not going above that. It's a double top. And then when it blew through that, all of a sudden they had to acknowledge that, hey, this is no longer a bear market rally. This is something more than that. But even then, all the way up through to today, every little sell-off, people, as I keep saying, institutions particularly, have one foot out the door. They're kind of halfway there saying, I got to stay invested. But every little sell-off, they get bearish. And then we get a little more than a little sell-off like last April. And you had sentiment go back almost to the 2020 lows. So what that all is that you've had a wall of worry. It comes down as you rally, but it gets rebuilt very easily with a 3, 4, 5% sell-off. And if you get something bigger than that, 10 or 15%, it really gets rebuilt. That allows this thing to have continual fuel. So from both a monetary standpoint and from a technical standpoint, this thing has just been, I think, uniquely positioned to keep extending. And what I have done, and because as you well know, I get beat up on, not so much lately, but beat up on X for calling for a bust, and having called for a bust for years. I go, but if you look at my what I've said all along, never once have you seen me, um, even in 22 when we were selling off, but never once have you seen me say the top is in, or that we're near the top. What I've said consistently is a global bust will follow the top. And I've continually raised targets and extended the bull market without any hesitation or without any lessened conviction. What's misunderstood is that there's no timing to that. I get myself in trouble, certainly, when people ask me, when do you think the bust is going to hit, or well, when do you think the top's coming? And, many times in the past, I've said, well, maybe, we might have another 6 months to go. And then when we get there, next thing you know, it's another year past that, and it's another year past that. So if I were a timer, I'd get Fs, if this were based on timing. But if you listen to my calls, it's not based on timing, is based on when do we reach my targets.
The market's resilience is underpinned by the Federal Reserve's unprecedented balance sheet expansion, which injected over $5 trillion into the global economy in just 18 months. This massive wave of liquidity has created uncharted territory, where historical valuation models fail to account for the sheer volume of capital still circulating through the system. Consequently, the rally has climbed a classic wall of worry, where persistent skepticism and premature bearish calls at every resistance level, from $3,500 to $4,800, have only served to fuel the ascent as underinvested institutions are forced to chase price. While a global bust remains the ultimate conclusion of this cycle, the analysis clarifies that this event is not driven by a calendar timeline, but by the attainment of specific price targets. Until those parabolic objectives are reached, the liquidity dynamics suggest the bull market will continue to extend, punishing those attempting to time a top based on sentiment rather than structure. Share your thoughts on his analysis in the comment section below. If you find this video informative, please support us by turning on notifications to stay informed about our latest videos. See you in the following video. Thanks for watching.